International diversification is theoretically and empirically important, but investors all over the world exhibit a home country bias in their portfolios. They tend to overweight the stocks in their home country relative to their country's market capitalization weight. For example, Canada makes up around 3% of the global market, but Canadians tend to allocate more than 50% of their portfolios to Canadian stocks. Home country bias is often viewed as a bad thing, and at the extremes, it probably is bad. But there are some good reasons to overweight the stocks in your home country. I'm Ben Felix, portfolio manager at PWL Capital, and I'm going to tell you why home country bias can be a good thing in moderation. In basic financial theory under the capital asset pricing model, the market capitalization weighted portfolio is the optimal risky portfolio for all investors. This suggests that an investor in Canada should hold Canadian stocks at their market capitalization weight of around 3%. The fact that investors around the world significantly overweight their home countries is known as the home bias puzzle. A puzzle like this can mean that investors are making persistent mistakes, or it can mean that investors are acting rationally for reasons not reflected in the model being used to define the puzzle. The capital asset pricing model makes lots of assumptions that don't reflect the real world. It doesn't account for costs and taxes, it ignores how the portfolio interacts with things like the cost of buying groceries in your specific country, and it's silent on how the treatment of foreign investors during times of crisis can affect investment outcomes. In Canada, the fees to own Canadian stocks through low-cost index funds tend to be lower than the fees to own foreign stocks, and investors receiving dividends from a Canadian corporation get credit for the taxes that the corporation has paid. On the other hand, a Canadian receiving a dividend from a foreign company gets no credit for the taxes paid by the foreign corporation. This increases the relative tax cost of owning foreign stocks for Canadian investors. All else equal, favorable costs and taxes make Canadian stocks a little bit more attractive for Canadian investors, but probably not enough to explain the large observed home country bias. A later iteration of the capital asset pricing model, the CAPM or Intertemporal Capital Asset Pricing Model, suggests that investors don't only care about how their portfolio behaves in a vacuum, they care about how it behaves relative to other stuff that matters to them, like buying maple syrup. Maple syrup was a bit of a Canadian joke, but in all seriousness, to the extent that the Canadian companies are producing cash flows that provide better protection against changes in the prices of local goods that people in Canada care about, some home country bias can make sense. The empirical evidence discussed later in this video does seem to support this effect. A less often discussed problem that can arise with international diversification is the treatment of foreign investors. International diversification looks great when things are going well and global capital markets are free and open, as they largely are today. But major world events like wars can cause markets to close up, and foreign investors don't tend to get the best treatment. In the early 1900s, many countries around the world had active financial markets, and European investors were being encouraged in popular investment books like we see today to diversify their portfolios internationally. French, British, and German investors exported huge amounts of capital around this time in search of returns and diversification through cross-border investment. Starting with World War I, global financial markets began to contract. Between market closures, foreign exchange restrictions, and, at the extreme, market nationalizations, foreign investors experienced a lack of access to their investments and the potential for meaningful or even total losses. This type of experience is not only an artifact of history either. Argentina instituted restrictions on the flow of capital in 2019, which continue to be a challenge for foreign investors, and Russia put restrictions in place in 2022 that affected the ability of investors in deemed unfriendly countries to transact in the shares of Russian companies. These types of problems are avoided by investing in domestic stocks. This is a point that Professor Eugene Fama made when he was on the Rational Reminder podcast, and it always stuck with me.
The problem is nobody cares about investors. Investors get expropriated, and so each side always expropriates the other side's investors, but they don't fix it after the war. It stays expropriated, even if you win. So that's the risk of international investing, and it's not gone. It's not gone.
One other point worth considering is that people care a lot about their relative economic standing. Given the fact that many Canadians have a home country bias, being the one Canadian without a home country bias when Canadian stocks are doing exceptionally well could be a psychological challenge. It was not that long ago that Canadian investors had to be convinced to invest outside of Canada because Canadian stocks were doing so well, and the Canadian dollar was appreciating, making returns for foreign stocks look that much worse. All of the preceding points are important, But another interesting angle to take on home country bias is purely quantitative. What did the data say? I think the largely qualitative points that we just covered are really important, but I'll be the first to admit that I get excited about data. A recent paper that I covered in a previous video found in a large sample of developed markets dating back to 1890 and through 2019 that a 35% allocation to domestic country stocks has been optimal over the full life cycle of saving for and funding retirement. 35% of the portfolio in domestic stocks perform better than other domestic allocations, suggesting a home country bias for people in most countries, the US being the big exception. The data set up in this paper uses a block bootstrap methodology, meaning that they pull multiple samples of real historical returns from a large data set and then string them together to form hypothetical return experiences. The benefit of this approach is that it allows the researchers to simulate, in the case of this paper, 1 million possible return experiences, drawing on the actual set of historical returns that countries around the world have seen. In their setup, domestic does not refer to any specific country, but to the simulated returns of a representative domestic country. It is important to note on this paper that they look at domestic allocations from 5 up to 100%, and while 35% was optimal, the differences in outcomes were relatively small between a 5% and a 50% domestic allocation, while the differences did become much larger, in a bad way, at a 100% domestic allocation. Importantly, these figures do not account for the generally more favorable costs and taxes when investing domestically. With these relatively small differences in mind, I think there's an element of reasonableness and preference that go into the home bias decision. But some level of home bias does seem to be sensible, at least based on that research. I do have 2 more research findings to share. Vanguard looked at optimal home country allocations using minimum variance analysis for Canadian investors in a 2023 paper, using data from 1999 through May 2023, and they found that a 30% allocation to Canadian stocks was optimal. I looked at Canadian dollar real returns for global portfolios with various allocations to Canadian stocks from 1900 through 2022, and similarly found that an allocation to Canada between 30 and 40% produced the best risk-adjusted returns. Some caution is warranted with findings like Vanguard's and mine, because they're specific to the time periods being examined. But it is somewhat reassuring that these results line up with the bootstrap simulations mentioned earlier, which attempt to address that exact issue. One note on all of these quantitative findings is that they are based on having a home country bias in developed market countries, either a representative developed market or Canada. The conclusions may not extend to people living in emerging markets. I'm pretty comfortable saying that there are strong theoretical, practical, and empirical arguments for having some level of home country bias in equity portfolios. But a common concern with overweighting a small market like Canada is that it may go on to have low realized returns. I get the concern, but empirically, the stock returns of smaller countries, where size is measured by total market capitalization, tend to be higher than larger ones. It is certainly possible that any individual country could have a bad long-term outcome, which, along with the previously mentioned empirical evidence, supports the argument to limit home country bias. But I don't think it's an argument to eliminate it. Another common concern is that insert country name has poor economic prospects. This one is coming up right now for Canada. It's always important to remember, though, that economic growth and realized stock returns are not as closely related as many people believe. In fact, they're somewhere between unrelated and negatively related. The reason is that expected economic growth is reflected in stock prices. Rather than stock returns being tied to economic growth, they're tied to how actual economic growth compares to expected economic growth, a very noisy, often random relationship. Additionally, in our currently global economy, many countries have stock markets that derive a meaningful portion of their revenue from foreign countries. No country is an island. Foreign revenues don't explain all of local stock returns, which is one of the reasons that we diversify globally despite the existence of multinational companies, but they do explain a meaningful portion of returns. Economic prospects aside, investors in some countries, including Canada, may be concerned that there are just too few companies for the market to deliver a reliably positive equity risk premium. But I don't see much of a relationship between the number of companies and the realized returns of country indexes. In fact, the best performing developed country index since 1970, Denmark, only has 16 holdings. Home country bias, overweighting your home country stocks relative to their capitalization weights, is detrimental at the extremes, but modest home country bias is theoretically, practically, and empirically useful. It can reduce fees and taxes, it may hedge the cost of local consumption, and it reduces exposure to the potential mistreatment of foreign investors when times get tough. It may also be helpful psychologically due to the role of social comparison in determining individual happiness. Empirically, a home country allocation of around 35% has been historically helpful in improving risk-adjusted returns and life cycle outcomes for investors in developed markets. Even lower domestic allocations, which still represent a home bias for investors in countries outside of the US, have been better than having no home country bias. In Canada, there are a ton of options for low-cost asset allocation ETFs which typically do have a home country bias. At PWL Capital, we typically allocate 1/3 of equity portfolios to Canadian stocks. Thanks for watching. I'm Ben Felix, Portfolio Manager at PWL Capital. If you're in Canada and want to learn more about how PWL approaches portfolio management and financial planning, you can book a meeting with us below.